So what happens when all the data on a stock seems to tell you two completely different stories at the same time? Today, we are diving deep into a really fascinating technical report on Hyperscale, ticker GPUS. And let me tell you, it's a classic battle between a massive short-term surge and some pretty serious long-term red flags. Let's break it down.
So why are we even talking about this? Well, it all starts right here with this number. On October 28th, the stock shot up over 10% in a single day. Now that's a big move no matter how you slice it, but it's how it happened that gets really interesting.
And this is the how. Almost 800 million shares changed hands. You know, that's not just a little bit of interest, that's a full-on stampede. This incredible volume is the engine that drove that 10% jump, and it's exactly why we need to dig into this data. Okay, so let's start by looking at exactly what went down. A surge like this doesn't just appear out of thin air, but the sheer force of it is what put this stock on every trader's radar. Just think about that for a second. We're talking about a leap from 40 cents to almost 55 cents. Now, I know the numbers themselves sound small, but as a percentage, that is a huge, sharp climb that absolutely turned heads and lit up trading screens everywhere. So if you look at this chart, just scan down that volume column, you can see the trading activity was kind of bouncing around, tens of millions, maybe 100 million on a good day. But then you get to October 28th, and boom, it just explodes to nearly 800 million. That massive rush of activity is what pushed the price to its peak for the week. All right, with a surge like that, you can bet there's a strong argument to be made for optimism, what traders call the bull case. And the technical report points to several key signs that suggest this upward move might actually have some legs. So the key thing to see here is that it's not just one signal pointing up. It's like a whole chorus of them singing the same tune. The data is showing us really strong short-term momentum, a trend that's actually getting stronger, a clear upward direction, and maybe the most important piece of all, a huge accumulation of volume, which suggests some big money is getting interested. Let's just unpack one of those for a second. On-balance volume, or OBV. It sounds really complicated, but the idea is actually pretty simple. Just picture a tug-of-war between buyers and sellers. When the volume is higher on days the stock goes up than on days it goes down, that OBV line climbs. And that huge 2.07 billion number, it's telling us the buyers are winning that tug-of-war, and it's not even close. And because of all that, the current price is sitting way above its recent 5-day moving averages. Think of these averages as a way to kind of smooth out the day-to-day noise and just see the immediate trend. The fact that the price is so far above them, that's a classic bullish sign. It shows the stock has really broken out of its recent holding pattern.
But, and you knew there was a but coming, right? This report is not a one-sided story. For pretty much every bullish signal, there's a flashing yellow light telling traders to maybe pump the brakes. So let's look at the argument for a little restraint.
Here's a direct quote from the analysis, and it's a powerful one. It says that the exact same massive volume that powered this rally could also be a warning sign of a blow-off top. That's a moment where basically everyone who was going to buy has already bought in, and the momentum is just about to run out of gas.
This brings us right to this idea of a stock being overbought. I really love this analogy. Think of it like a car's fuel gauge, but for momentum. When that needle is way over in the red, it doesn't mean the car is going to stop dead in its tracks, but it's a pretty clear warning that it's been running really hot, really fast, and a cool down or a price pullback is probably coming soon. And here it is. This is that fuel gauge needle absolutely pegged at the maximum. An indicator called the stochastic RSI, which is designed specifically to measure how fast and how far a price has moved, is sitting at 100. That is, by definition, as overbought as a stock can possibly get. It's a major red flag that suggests this rally is stretched incredibly thin.
Now let's zoom out for a second, because the story gets even more complicated when you look at different timelines. All this recent action is happening down around the 40 to 50 cent mark. But look at the long-term 200-day average, it's all the way up at $2.30. This tells us that this recent rally, as exciting as it is just a small blip in what's been a much larger, longer-term downtrend.
And it's not just one average telling us this. A broader statistical tool called a linear regression, which is really just a fancy way of drawing a line of best fit for all the recent price data, confirms the same thing. Despite that exciting one-day pop, the overall long-term trajectory for GPUs has been pointing down.
So you have this incredibly powerful short-term surge fighting against all this long-term weakness in these exhaustion signals. What happens when an unstoppable force meets an immovable object? Well, the report lays out 3 possible ways this could go.
First, you have the bullish scenario. The buying frenzy keeps going, the momentum just builds on itself, and the stock smashes through the next major price ceiling. Second, the bearish scenario. Those exhaustion signals were right, sellers take control, and the price falls back down to find a new floor. And third, the neutral path. The bulls and the bears basically fight to a draw, and the stock just kind of chops around sideways for a while, digesting this big move.
And the report gives us the exact battle lines to keep an eye on. That 65-cent level is the resistance. Think of it as a ceiling where a bunch of sellers are waiting to cash out. That 47-cent level is the support, a floor where buyers who missed the first rally are probably waiting to jump in. And that 58-cent pivot point, that's the center line, the point of control. Whichever one of these levels breaks first will probably tell us which scenario is playing out.
So after all that data, all those charts and indicators, what's the core story here? What's the one thing you should really walk away with from this whole breakdown?
It's this. The story of GPUs is a classic tale of conflict. You have this incredible, explosive, short-term momentum running headfirst into these really clear signs of exhaustion, all while being weighed down by the gravity of a weak long-term trend.
Ultimately, what the data is painting for us is a picture of a stock at a critical turning point. So the question the report leaves us with is this one. Are we witnessing a genuine breakout moment that signals a real change in fortune for the stock? Or is this just a dramatic but ultimately short-lived flash of brilliance in a much longer story of decline? The data has made its case for both sides. The next few trading days are going to write the ending.